Trades. Today in this video I'm going to talk about IV Cross, how to play earnings and what to do and what not to do. So let's get it started, right? So now we can see that, right? So IV Cross is real and it impacts a lot. So if you are playing weeklies, and a lot of people had questions about how is the IV Cross for the long-term contract and everything, so we're gonna look into all those things, right? So let's get it started. So this is Tesla was today was around 420 after hours. Okay, so after hours seems like they did pretty good earnings, and they are up $14, but not much, right? They're 3%, which is pretty regular. Like Tesla is up 3-5% any day, so not a big rally up or down, just kind of okay price, right? Not up, not down. So basically, what does it mean for your options if you got calls or puts, right? So puts, you are pretty much toasted, right? So if you got puts, it's up, even if it's a little bit, it's up. So you are pretty much gone. You may be able to salvage, get a little bit out of it, but not much. But let's look at the Tesla options and kind of look into, right? So Tesla was around like 220, 225, right? So today, so let's say you got a buy call for 430, right? So if you look at buy call for 30, you paid almost $14, right? And you can look in that your break even is 440, 420. This is, it has to be by Friday. So you don't have much time. Again, tomorrow it can run, and if it goes, you may make some money, but the chances are if it just hovers around 36, 37, so this contract, it did went a little bit up, so it will help a little bit if you're in a call, but all it depends is how much is IV, right? So let's look at the few of the numbers. One thing is theta. Theta itself is 4.34. So just by holding it, you will lose $4, right? So you will lose $4 no matter what. Just forget about implied volatility. You just lose theta. So you already lost 434 just by theta, just holding one night. Now, to make up for it, delta is about 45 for this contract, so almost zero point 0.5, I would say, right? So what was the move? The move was about $10, so 10 times half is 5. So basically that move just offsets theta. So given that move, you had big theta, so it will just offset. So let's say if everything is constant, your price would be 1420. But the most important thing is you have to look at the IV, implied volatility, right? Implied volatility is 140% right now, right? And the Greek, which kind of tied to implied volatility, is vega. So vega is 0.12. So each percent down in volatility, the option price will go down about $12. So if it's 1420, so let's say if it drops 20%, right? So if it drops 20%, you are losing. So if it drops 20%, you are losing about 20 times 0.15. It's just 124, so 15. So you're losing 3. So you're losing $300 if it's 20. We don't know yet, right? How the implied volatility gonna be. We don't know. So probably I think it's gonna be 20-30%. So Tesla is pretty high, but it will drop significantly than today. So if it drops, like, that's 20%. If it's 40%, you are looking at $600. If it drop, like, let's say 60%, you're looking at $900. So just, even if it went up a little bit, you just lose, right? That's what that. So the only thing is, like, it has to move really high, really high. That's all, right? So a lot of people have other questions like, what about spreads? Are spreads safe? So it depends, right, where you got in. For example, if you got in like 150, 160, even if it's spread, I mean, you don't have much time. You just have one day, right? So you will be impacted. The volatility is gonna go down, theta, and you don't have a time, so it will impact. But as long as you are in the money for both legs, you are fine. But it has to be by expiration. So if you are right in the border place, probably you'll make like half. Like 35, 40 will probably gonna go maybe tomorrow about $200, $300. So depending what price you got in, you can sell out. But if you got in something like, let's say, 30, 35, and if it remains above the 436, you don't need to worry about volatility or whatever, right? You are in the money, you have intrinsic value for both the options, and if it expires in the money, you'll get max profit. So that's good if that happens. But and the other things I wanted to point out is I mean if we play earnings, it's a hit or miss, right? Tesla had a pretty good earnings, and they did not really they beat EPS, they beat their revenue, they had good forecast, and pretty much, but Wall Street was not happy. And a lot of times they have a very high expectation. They are just of course the price, the Tesla is really highly valued right now, and people are expecting them to just blow out the earnings, right? How Zoom did it last time, right? They literally did like I mean they literally did in a quarter revenue of the whole year. So that's really great, right? So if someone does like that blowout earnings, you could be lucky and you could make a really good money. But if it does not move that much, it's like 3% is not a big move. So basically if you got like 480, 490, 4, something like that, it's toasted, it's gone, right? So pretty much you will lose everything, whatever the value today was, because of the earnings. And yeah, so I just wanted to kind of point that out. And a lot of people kind of do strangle too, which is just buying and buying calls and puts. So it's just expecting big move, so which also needs a really big move. So the problem with the earning, it's really unpredictable. Sometimes you have a really great earnings and it just drops because expectation was so high. Sometimes they have okay earnings and good guidance, so it just moons because the guidance is good. And sometimes everything looks good and it just kind of in the same place. So it's really hard to judge. So it's mostly like a coin coin toss. But what good is like most of the time it works is playing till earnings run up. Sometimes it does not work, not always, nothing works always. And one thing is, if something has a really great earnings, and if it's a good breakout, if you are looking at the good rise with the volume, so it's a good news. So that's a good catalyst, so you can play day after tomorrow or whatnot, right? So there are a lot of ways. But with the earnings, unless you are really in the money, really right there, again, that you have to be bullish, right? So even if you get in the money, let's say if it was 425, 425 when we about closing, and if you got 425, 430, I mean, we don't know, it could, if it goes down, then you lost it. But if you are really near in the money, and if both the legs get in the money, you could make. So it looks like when we close, I don't know how accurate the price is, I won't trust the after hours price much. But if you look at this looks pretty cheap for the risk reward. So 425, 430 was only $2. This is not really a lot because you are right there. So, and even if you get next week, probably good, but that's not bad, right? That's a $2, and as long as it's above a 430, you should be fine. You'll make 500, so double your money. So that's good. But yeah, I just wanted to point out. And other things that I just remember, other things a lot of people said question was how the IV cross happens for the like long-term contract. The thing is, like, the volatility will impact, but if you look at the volatility for a long-term contract, it will be lot less. So for example, if you go, let's say, just for the heck of it, September 21, it's really expensive probably, but we'll just look into it, right? Yeah, it's super expensive. So for 450, right? If you got 450, you can look into that, right? The implied volatility is high, but it's still not as 140, right? This 140 was just because of the earnings, that's all, right? This one is really high. I mean, this one is high. I mean, this is not low, but it's just Tesla, right? But it's not much. So it may drop a percent or something. So you will lose $100 or something, but not much. But chances are, I don't know, maybe I want to check this. So I'm gonna screenshot that and maybe check tomorrow what's the implied volatility show. But looks like it's 69.31 today, so you guys can check it out too. So it will not change much, it may change a little bit, but a percent decrease is $156 here. But this contract itself is very expensive, almost $10,000. So you gotta keep that in mind. The volume is not much open interest, but yeah. And if you look at like near term, right, October 30, it will be pretty much same, I would say. Yeah, it's 89, not as much as. So basically, if it's the earning, it will be really high for next week or something. it will be a little bit high just cause of the earning, but not much. So you can see that it was, so think about it, like if it drops to this level tomorrow, so how much you're losing. So it was 140 here, almost 50%, right? So if you calculate, so it was about 0.15, so 50 times 0.15 is basically 750. So you're losing $750 just of the IV crust. That's a lot of money, $750 in a contract. That's also for 450, which is not there yet. So you basically lose a lot of money just because of the IV. So yeah, so this will be probably worth what, 450 tomorrow. Seems like theta and delta will compensate. If that does, then it will be about again, this will be about like if it's 1500, about 750. So you just lost half of the money, and it has to go really high. So it works if you are really right, and which is really hard to. If you are really right, then you don't even need to play earnings. You can play anything, right? Nobody can be 100% right. It's just, a lot of variables. But I guess you guys get the idea. Yeah, that's it today. Thank you. And yeah, if you have not liked or subscribed, don't forget to like and subscribe. That's about it. Thanks.